The turbulence in the financial markets have triggered panic among retirement investors. This has led to many retired people switching their investments when their investment portfolios are not performing well. According to a study conducted by Momentum Retirement, investors performed more than double the volume of those who switched their investments last year, and that about 50,000 switches in retirement funds resulted in nearly R500 million in value destroyed between 2020 and 2021.
So people in retirement are obviously going to feel the effect of market movements a little bit more because it's having a direct impact on their portfolio values, have a more direct impact on their income that they're drawing. So this sort of trend, we've seen that in retirement investments or in living annuity products, we're seeing that switching actually was a lot worse and it actually destroyed a lot more value. So in 2021, on average, investors who were moving money around in living annuities were destroying 4% of their portfolio values on average with each switch that they performed.
The market turbulence and unpredictable economic conditions poses a major concern for the future economic outlook of South Africa as a whole. Switching of investments also lead to the loss of value in retirement funds. Experts say that about 80 billion rand is flowing out of retirement savings every year, and that this is caused mainly by workers not preserving their retirement funds when they change jobs.
During COVID, from 2020, March 2020, when markets crashed, we saw this perfect storm. We saw a drop in value in markets. We saw a tremendous amount of uncertainty entering markets. We saw people fighting over toilet paper. We saw, and in addition to that, in South Africa, we saw, that sort of coupled with electricity shortages. And, now we're seeing rising interest rates. So there's a lot of uncertainty out there at the moment. And what COVID has done, and why I say it's a perfect storm, is that there's been a tremendous increase in digital adoption around the globe. So people are a lot closer to their investments. They can see these values on their phones. They can see these values on websites, and they're monitoring the value of their investments. And often what they do is they tend to engage with this increased digital adoption and they move the money around.
Experts say that failure to adequately save for retirement is forcing many people to try and take more risk to play catch up, and have cautioned investors not to time the market by switching their investments when the going gets tough. Investing towards retirement is a long-term investment, and the market do recover over time.
So we can see a phenomenal trend, a very strong trend of risk off when markets tend to get volatile. So it's exactly that. People are moving from stocks, they're moving to cash. But the problem is, so look at property as an investment class in 2020, for example. Property was under a massive amount of pressure from COVID, but sort of people were leaving the city centers. People were sort of leaving Sandton, right? They weren't driving into work every morning. So it was more difficult to rent that space out. So property gave quite a large negative return in 2020, but the year afterwards, it completely rebounded. So what's happening, and this is again this behavior tax, is people leave when they get the big negative return, and then they miss the big positive return that invariably comes. So it's exactly that. The problem is that people try and time markets, and we know that that's not possible. There's not one person in this world that is able to predict accurately what is going to happen with markets.
Lack of sufficient savings for retirement is likely to affect retired people's standard of living during retirement. Naledi Matlapeng, SABC News, Johannesburg.